I think back to the well-known literary terms, right? It was the best of times, it was the worst of times. These were not the best of times. The thing that really one of the things that really sticks in my mind is what I used to call the weekend roll-ups. But back at the time, a lot of the matchmaking that would go on between banks with capital and banks that were failing would take place over the weekend. So you had kind of a constant stream of after the weekend deal announcements. And it actually got to the point that my wife Tricia stopped making any family plans at all after lunchtime on Sunday because she just assumed I'd have to work Sunday night because some kind of a roll-up deal would be announced.
You know, the course of history of the banks from that point on largely shaped by the regulation that ensued from the financial crisis. So when you take a look at the banks in the field that we have today and in what businesses they are, what is as a direct result, in your view, of the financial crisis?
Well, I mean, there's been a lot of changes, and I think one of the biggest lessons we learned, and unfortunately it's a lesson we keep forgetting and having to relearn, is the importance of liquidity. It's not so much does a bank have enough capital, are they over-leveraged, so they have enough cash to get through the real crunch time. And I think that's been one very important change, both regulatorily but also with management teams. They're paying a lot more attention to kind of liquidity management, which I think is a very important key. A lot of the other things like higher capital levels and some of the business exits, I think there's kind of some goods and bads there, but we definitely learned some things from the crisis, and I think we're actually quite a bit better off now than we were coming into the crisis. There's a few things we can kind of cite and discuss there, but one underlying point I want to make is, of any points I would make, the one I'm the most confident in is that there will be another financial crisis, and we're not quite sure where it'll come from, but it will happen again.
In terms of valuation of the banks today versus then, Jeff, you know, I used to talk to you 10 years ago when I covered the banks, and I covered those firms that don't exist today, as you recall. But, you know, we'd always talk about the price-to-book ratio. So when you fast forward to today, do the banks today deserve the same sorts of metrics, the same sorts of price-to-book valuations as they did back then? Yes, they are safer. They have more cash on the balance sheet. Their ability, though, to take on risk and make more money is limited, is constrained.
Yeah, it's just funny. It seems like it was a lot longer than 10 years ago we were talking about banks. But when I look at valuing banks, and especially any with kind of capital markets exposures where they're kind of more of a mark-to-market balance sheet, I'm kind of used to regressing book value versus the ROE they can earn. And we see much lower book values today than we saw back then, but we also see much lower ROE. So I think when it comes to banks in general, that the kind of price to book still holds as long as the ROEs are there. The place where it's broken off a bit is in some of the GSIBs, the really big banks. I think the price to books that they're trading at, be it a B of A, a Citi, a Goldman Sachs, really are probably too low relative to their ROEs. I think that's something the market's just got to get comfortable with, and they will get comfortable with over time. But generally speaking, that relationship, I think, still holds up fairly well.
What's wrong with Goldman Sachs? We were just talking about Goldman having its longest losing streak since 1999 when the company went public.
Yeah, I mean, look, they had a tough year last year, especially in fixed income trading, which is a big business for them. They had some problems in commodities. There's concerns that it was more than just problems in a business. That maybe there was some business-related issues at Goldman. I think we're seeing that that's not the case. I mean, they've come roaring back again this year. What's, I think, been preventing them from being a standout this year is there's a lot of concerns about trade, right? Trade concerns and the impact on global kind of finance and business flows is what people are worried about, and Goldman sits right in the middle of that. But if we do see, which I think we will see, kind of trade fears subside, I don't think we're going to come into a trade war. The type of capital markets activity levels and backlogs we're seeing should play right into Goldman's strength. So it's had a tough year, as of a lot of the big banks, but I think Goldman's one you're going to want to own into year end.